Hey everyone, welcome in to another daily editorial here on the KE Report. We're focusing on the energy sector, oil and natural gas, including the underlying equities, as we are chatting with Josef Schachter, founder and editor of the Schachter Energy Report. Josef joins us every month to recap some of the macro forces around the oil and natural gas price and then talk about the underlying equities. Let's start off with oil here, Josef. We've seen oil, I guess we can call it, continue to grind higher ever since kind of that December low that we saw in the crude price, down just below $68 a barrel. Now, crude is knocking on that $80 a barrel level, off of some of the highs from just back in October of 95, but there is this general uptrend here. In terms of the whole macro picture for oil, Josef, where should investors be focused? What's going to drive the price either higher or lower from here?
Okay, there's two parts to the story. Let's start with the bullish side. The bullish side is OPEC has decided to keep their quotas, even though they're not abiding by them, but they're going to keep them definitely through the end of Q2. They're meeting on June 1st, and the market is expecting them to continue the quota cuts into the end of the year. So that's one of the bullish things that took it up to $80. Also, the data coming out of China with recent exports showing that there is a recovery in the China economy. Some of the India data about how they're growing has been very positive. And of course, they're going to use more energy going forward. And they're, of course, trying to get rid of coal. So they're going to be buying more natural gas over time, more LNG. So that's been the positive side, or liquefied petroleum gas. So that's one of the positive stories. On the negative, U.S. commercial inventories continue to grow. And we saw that this week with the EIA data, that the inventories grew 1.4 million barrels. And they're closing in on what they were a year ago. And also, we've seen the SPR growing every week by about 700,000 barrels. And it's only like 10 million barrels below what it was a year ago. So we're seeing, restocking going on in the United States. U.S. exports, interestingly, have been coming down a little bit because Europe has not been such an aggressive buyer. Exports fell last week 91,000 to 4.64 million, and we were over 5 million a while ago. So with Europe not buying, and of course the United States doesn't want to sell any of their oil to China, you're seeing Europe slow down their buying. And that's been a drag a little bit. My view is between now and, let's say, the summer, because we go into the shoulder season, demand for all of this year will be, 102 million barrels. And, during the winter and during the summer driving season, maybe 103 to 105, depending upon the day. But during the shoulder season, it can get down under 100 million barrels, which would be March, April, May, June. And then, of course, September, October. So I think we're still having a shot here at maybe prices coming below U.S. $70 a barrel. And so I'm somewhat cautious on chasing stocks here. I think we're going to see a bit of a pullback. And if that doesn't happen, you'll get a better buying opportunity.
Well, thanks for covering oil, Josef. Let's also quickly look at nat gas. There's a range of opinions on natural gas, and some of it is the optimism about the upcoming LNG terminals, but there's also the reality of not that great of prices right now in the near term. So how are you looking at the natural gas fundamentals?
It's, again, a tale of two cities. 2024 shit and terrible. 2025 probably pretty good. It's just the problem is until the Freeport facility comes back on, that'll add a couple BCF a day in terms of pickup and demand. You're seeing a lot of companies announcing that they're going to stop spending. EQT will cut back about a BCF a day. Chesapeake will be about the same. So the producers are cutting back. Some of them, like EQT, said that they need $350 US and MCF to justify spending more money. So the pullback in spending will hopefully help a little bit on the storage, but the storage really doesn't get better until you get into winter 24-25, when we have new LNG plants coming on and we start filling the pipeline for coastal. So it's a question of, how bad, if we have weather in the summer, which is moderate, and you don't have a strong air conditioning season, we could see AECO, plug under $1, which is terrible. But if you get into November, December of 24, we could be looking at $3 because number one, Freeport's back on and exports from the States with the new facilities will go to Europe and Asia, and at the same time we'll have LNG Canada taking gas and getting ready to ship off the west coast of Canada sometime in early 2025.
Joseph, let's get into the stocks then, because look, that's where a lot of people want to invest. And one thing we've broadly heard is that the oil stocks continue to struggle amidst this generally better price environment for them, but also the oil price is off of its highs from last year, also from a couple of years ago. You look at something like XLE, though, and XLE is doing just fine. It's trading more in a range for about a year and a half now. What are you seeing within the oil stocks, especially recapping some of the Q4 earnings that we've been seeing?
Yeah, I think you got to go and look at it from the point of view of those companies that are involved to take advantage of the TMX expansion. So you're talking about the oil sands firms, the big SAGD firms. Those are the ones that are going to benefit with increased exports. They've built up the 150, 200,000 barrels a day increment from what they were. So C&Q's expanding their production, Cenovus, Meg, all these guys are growing their production, Suncor, and so they're going to be the big beneficiaries, and they're the heavyweights in the in the big indices. They're going to be the ones that are running right now, and where investor interest is there because of the new pipeline takeaway capacity. And TMX, as we mentioned, is going to take oil starting in April. The general oil and gas industry, the smaller and medium-sized players, are all still focusing on number one, balance sheet, getting them back in order under 1x debt to cash flow, and many companies still are in that mode. If they're small to medium-sized companies, anything under 30,000 BOEs a day, they're still looking at getting their balance sheets healthy. And then, of course, the pressure is on for shareholder returns. So some companies are looking at NCIBs, and they're pretty active on them. Others are looking at a mixture between dividends, special dividends, and NCIB. And so that's really, the issue for the industry is where do you want to be? How cheap are you trading versus your PDP and 1P value? And then what do your shareholders want? But the key thing is, to start it off, is balance sheet. Like the days of growing, drill, baby, drill are gone. The issue now is companies want to be able to survive if there is a recession and if oil does go back down below 70 for any sustainable period of time. Survivability, because if you remember, not 4 or 5 years ago, we lost quite a few companies in Canada because the price of oil and natural gas got hurt, and they had too much debt. And so getting away from debt, getting away from the banks breathing down your neck and telling you what you can and can't do with your dividend, can or can't do with CapEx, companies are saying, I don't want to be in that boat again.
Yeah, Joseph, you can't blame them because they went through a pretty rough decade, actually, before we saw the liftoff in 2021 and 2022. And a lot of them still remember how the banks treated them. So can't blame them for wanting to shore up their balance sheets, buy back some shares, and focus on debt. But if as an investor is looking at the space, investors want to see growth. So how do you balance out their desire to maybe get a little more defensive, pay down debt, or maybe buy back some shares versus putting some money into the ground with the growth wedge? What do you want to see as an investor?
Well, the companies that are talking growth wedge are talking 3 to 5%. So a Whitecap, you've got a Surge, you've got a number of others that are talking 3 to 5% growth, while others are saying paying down debt, which is what Vermilion is talking about, Crescent Point is talking about. And then you've got some that are saying, okay, we digested a couple acquisitions in 2023. We're going to sell non-core assets. So there's a lot of product out there. The question is, the difference between the views of the buyer and the seller. And of course, the buyer doesn't want to pay for $80 oil, when their internal budgets are saying 73, 75. So they're going to be wanting to pay the equivalent of 73, 75 with some upside to them, which means they may only want to pay $70 for the reserves in the ground. And then hopefully they have drilling locations to offset depletion over time. So the gap between buyer and seller, I think, is pretty wide right now. And while there is a lot of attractive companies trading around PDP right now, those same companies may not have a growth wedge until 2025 of any substance. 3 to 5%, it doesn't excite me. It's the companies that are potentially going to do more. And there are companies out there that are giving you growth plans out to 2027, 2028 with double-digit growth rates. Paramount is doing that. There's a number of others that are talking, Crescent Point, that are looking at some pretty healthy growth rates going forward. But they also, at the same time, are still divesting of what now are non-core, but originally were core assets, but not as important because there's the size of the plays in the Montney and Duvernay are so big, and it's a manufacturing business, and they know how to do that well. And with new technologies and new fracking techniques and longer reach horizontals, the economics are getting better and better and better.
So, Joseph, I'm curious to hear what your take is comparing the big players to some of the smaller, more of the exploration or smaller stage production companies, looking at something like the XLE, which is the ETF focused on energy stocks in the S&P, or VDE, which is the Vanguard broad oil stock ETF. Those are both still very close to all-time highs. But then you drive down to XOP, which is the exploration and smaller producers. Those are 50% down from their highs. So a big discrepancy there. Is there catch-up that these smaller guys can do, or is this a big producer's game still?
The market, because of TMX and because of the $79 oil, and you convert the 1.35 for the Canadian dollar, it's over $100 Canadian. That's where the market is now, and that's where the big institutions are chasing the stocks. I'm a contrarian. I want to buy value, and I want a catalyst coming in a reasonable period of time, a year, 2 years at the most, that can create an upside of 2 or 3 times from the current price. And that's what I see happening for so many of these junior E&P, because once we get coastal gas moving gas 2.1 BCF to the coast, once we see if I'm right and we see $90 oil in 2025, then I'm going to be looking at some very, very strong cash flows. Companies will have got through their debt pay cycle done, and they'll be looking at growth or shareholder returns. And if you're trading under PDP, why go out there and drill a well when you can buy your shares on Bay Street and increment the returns for your shareholders? So I think 2025 is the year of the small and medium caps. 2023 has been the year of the mega caps, simply because people who wanted, in the institutional side, wanted exposure to energy, didn't want to go down cycle and have to do some homework on the companies. They just said, buy CNQ, Suncor, Imperial, Cenovus, Meg, and just buy them. You don't have to do any homework. Just the leverage to the price of oil, done.
Well, Joseph, with the strength of the larger cap stocks over the small caps, and with you thinking maybe the smaller cap, the junior side of the business maybe pushed out to 2025, do you think some of them will use their strength to go on an acquisition streak? We saw some of the bigger companies like Exxon taking over Pioneer or Chevron taking over Hess. We saw some mid-tiers like Baytex taking over Ranger Oil. But do you think some of those small to mid-sized companies may just have a target on their back where some of these companies do get acquired?
Well, the problem you have is if they're trading so cheaply, there's 2 issues. Number one, who's going to be the buyer? If you're a big company and you're focused on oil sands or SAGD, you're not going to want a conventional oil player. You're still selling that off. If you're big in the Montney and the Duvernay, you want to get bigger in the Duvernay and Montney. So maybe you might want to look at companies there. But if you're a company there and you've got strong shareholder involvement, you're not going to want to take a cheap deal. So unless you have a company with a small shareholder position, you're not going to see a deal there. And a lot of these smaller companies are looking at the privates, where the pressure of the banks and the interest rates going up. So there's tuck under deals. So if you're a 20,000 BOE a day company, you could probably find deals at 1 or 2, 3,000 BOEs a day that you could go out there and buy to add to your core holdings. And that's what I think is what you're going to see from the small and medium companies, is that they go after tuck-under deals, bigger concentrations where they have contiguous land, so that you can drill longer reach wells, you can put facilities in better locations to manage the business more efficiently. So I think the small will grow, the medium will grow, and the takeover mania, there could be international players that may want to come in and take out MEG or take out Cenovus, during the cycle. But, Suncor I don't see being taken over. CNQ will definitely, I don't think gets taken over. So, I think that those bigger companies, there's only a few that are potentially takeouts as foreigners finally. And again, I don't think foreigners will want to come and take a big bite out of Canada unless there's a change in who runs Ottawa, simply because of the anti-energy approach of the Liberal Party, especially the environment minister. And a lot of the companies ran from Canada when Trudeau came in. They're not going to come back until they see clear daylight that there's no anti-energy focus coming out of Ottawa.
Let's move over to the natural gas stocks then. If the outlook still is kind of being pushed back even into next year for a better pricing environment, what do you think of these stocks? Can you go bottom fishing now, or will we see potentially lower prices in the natural gas stocks?
Well, I think the companies are talking about potentially, dollar or less during the summer. So they've got that, and they've got hedging in place in many, they've done hedging before so that they cover through that summer period. But remember, a lot of these companies have 20, 30, 35% liquids. So, the liquids probably give 60, 70% of the revenues. And if you got, $78, $79 and a $1.36 Canadian dollar, you're over 100 there. So I think the companies are expecting, lousy prices for natural gas this summer. And then they're saying, okay, I'm not going to spend money drilling dry gas wells. I'm going to drill my liquids-rich wells, so the liquids pay the bills. And you're seeing that with the drilling in Canada. It's mostly focused on the Montney and the Duvernay because they want the condensates, because the condensate is needed as a diluent to move those heavy oil barrels that are going to go in the TMX pipeline. So the industry is being very smart, going after the highest value product, and the low value product, dry natural gas, isn't getting taken in terms of activity. But if you have byproduct gas in a condensate well, but the condi, let's say you have a 1,500 barrel a day well and there's 800 barrels of condensate, the rest is natural gas. If they get zero for the gas, they don't care. The condi pays for the well.
Well, Joseph, you're very good at being a contrarian in the energy sector and buying when it's low. You have mentioned that you want to see a potential pullback in oil to where it goes under 70, where you would get table pounding bullish if it got back in the 60s on a number of stocks. But with nat gas so depressed, and if it stays depressed, are you more contrarian on the pullback in oil stocks or the continued weakness in nat gas if you had to pick between the two?
The market runs based on what happens to the price of oil. And so, when the price of oil, was below $70, you saw everything cheap. Both natural gas and oil stocks were cheap. So I'm thinking that the market, because if you look at the revenues that are created, the condi and the oil and light oil, heavy oil, medium gravity oil pays the bills in Canada. When we have $6, $7 natural gas, of course the industry makes out like really, really well. But I think that if I'm right that with the shoulder season is going to see sub $70 WTI, I'm not chasing anything. I've got a few nibbles out there if stocks get cheap enough. And what I would be looking at is PDP. You get under PDP on the 2023 reserves from Spool, GLJ, or McDaniels, you can stick your neck out. Could the stock go cheaper if we get below 70? But you know that if you're paying under PDP and the market has a good run in 2025 and it gets up to 1p, you're going to see a significant 100% move in the stock. So, if you buy it at X and it goes to 0.0x, 0.8x, but if it's going to go to 2 times X, from 1 to 0.8, if you're nibbling away and adding to a position, why not?
So, Joseph, what about those people looking at these stocks, whether oil or natural gas stocks, and just want income? They want to play the dividend. Are there good opportunities in your eyes still to just lock in some investments where at least you can generate some yield no matter what the pricing environment for the underlying commodity does?
So let's start with pipelines and infrastructure because there are a lot of companies there that can provide some very nice yields to clients. So you've got Enbridge there. They just had an investor day. TC Energy has got a very nice yield. Topaz just raised their dividend, a penny a quarter. And then when you go to the E&P companies, you've got Whitecap with almost an 8% dividend yield. You're sitting there with a good dividend yield in Surge Energy. You're looking at companies like Hemisphere, In Play Oil, which are smaller that are paying nice yields. Petrus pays a nice yield, almost 10%. So I think that there are companies you can go out there and get some good yield. And if you don't want the volatility of the oil price impacting you, then look at the pipeline infrastructure royalty companies where you don't have the same volatility and you're getting some pretty handsome yields. And if you can buy them at the right price, and that's what we started doing when we did our webinar, on February 29th, is we said, look at these companies and buy them when they're down, because if you can get 5-10% capital gain plus that 7% dividend yield for dividend-focused, people, those are fabulous returns. And if you're more, interested in the E&P side, wait for the pullback in oil because the yields might get you a little bit better. Like, Whitecap is trading today at $9.68, under $9. I think it's a fabulous buy. So you got to be, focused on what buy level makes sense to you, and be ready to pounce if you get those pullbacks.
Well, it sounds like a lot of the companies you mentioned, the pipeline and the drilling companies are in the oil services part of the sector. That has actually outperformed a lot of those companies, the oil or the nat gas companies. As far as a diversification metric inside of your portfolio, how do you view having a good percentage to the oil services? And is there anything that would change with the oil services companies where they would become less attractive in a different kind of pricing environment?
Well, the key is for them is if they have a strong balance sheet, if they have the latest equipment, be it the DGB4, latest tier equipment, with for fracking with low emissions and things like that, using natural gas versus using diesel. So one of our favorites has been Trican for a long time. Fabulous company with the balance sheet is pristine. It's got cash on the balance sheet, no debt, and they're paying a 4% dividend yield. So, if you can buy the stock at, in the $4 range, which we've been, anytime it gets there, I'm a buyer, so it's a bit above that right now. The stock's $4.32 today, up 16 cents. So on a flat day for the TSX oil and gas index, Trican's up 3.8%. On the same day, you've got Vermilion down 4.7%. And others down 3-4% on the day. So Trican's having a good day, and on weakness, I'd be looking to add to that position. Step on weakness is a good company. We added Total Energy last year to the buy list, and it's up a couple bucks from the low, so it backs off a bit. And you could look at a lot of different companies in the service side. The drillers, we added Ensign Energy to the buy list, and we bought it under $2, and it's $2.40 now. If it backs off, it would be something we want to add to again. So the industry the fluctuations happen in the sector. They're high beta, and if we do see a pullback in the price of oil and a pullback in the general market, and the general market looks top heavy to me. We're already seeing some problems with Tesla and Amazon, and so some of these stocks are getting a bit heavy. And if we do see the AI related love affair end, I think we're going to see a general market pullback, and energy is high beta, and we'll be getting some better buying opportunities. So I'm a buyer on weakness, and I think 2025. So if you take a 12, 18-month time horizon, there's a lot of stocks that will go up 50%. And if you really pick the right ones, you could see doubles between now and mid to the end of 2025.
All right, Joseph, thank you very much for your time. Again, Joseph is the founder and editor of the Schachter Energy Report. You can subscribe to his report, to tune in to his webinars, and read over all of his company reports, which there are a lot of them right now with that Q4 earnings season. It's a wealth of information for all the active investors in the energy space. Joseph, thank you very much for your time. We'll chat again next month.
Looking forward to it.